was quoted as saying, "Junior mining is dead." And what's your response to this quote here?
It's easy to lose 80 or 90% of your money in junior gold mining stocks. And I mean, I know for a fact because I have some accounts transferred to me from people. And, you know, they'll say to me, it used to be $1 million, but it's probably a couple of hundred now. And of course, when I get it, it's nowhere near a couple of hundred. It's 80,000 or something. I mean, so people have lost significant amounts of money. Those people won't come back anytime soon.
Greetings and welcome back to Mining Stock Education. I am your host, Bill Powers. Thank you for those that have been engaging the show and sending me emails. My email is at bill@miningstockeducation.com. A few of you have submitted questions and feedbacks through my website on the contact form, and a couple of those emails were incorrect. So if you didn't receive a response from me, just make sure that you submit the correct email if you choose to go through the contact form on miningstockeducation.com. We're going to be talking about the resource markets today with one of my favorite people, veteran resource manager Adrian Day of Adrian Day Asset Management. Adrian, thanks for coming back on Mining Stock Education. And could we kick it off by you sharing some of your key observations from the two recent conferences, Beaver Creek Summit and the Denver Gold Forum, please?
Yeah, absolutely. And thank you, Bill, for having me. You know, both conferences were very well attended, I thought. There was among the investors what I would think of as realistic optimism. I think perhaps the more interesting thing to talk about would be the some of the attitude, approach, if you want, or the sentiment among the mining companies themselves. Beaver Creek, of course, tends to have more junior companies, a lot of exploration companies, and those companies will be having meetings both with investors but also with more senior companies looking for assets. A lot of the exploration companies were, I think, extremely optimistic about, the interest from more senior companies in their projects. But I think, frankly, to some extent, that was misplaced optimism. I mean, for example, just as an hypothetical example, this is not referring to any particular company, a senior or mid-tier mining company operating in Mexico in silver is going to look at every silver exploration project that companies have in Mexico. It doesn't mean that they're necessarily going to make an offer to the company next week. And I think a lot of the juniors got a little carried away at just how many meetings they had with the seniors. But nonetheless, there's no question that the major companies, major and second tier, are looking. There's no question about that because, one of the fundamental themes of the gold business remains, and that is there just isn't enough, there aren't enough good quality gold or silver projects around. And and the senior mining companies producing anywhere from, 1 million to 5 million a year, have to replace those ounces, and that's not an easy job. So they're always going to be looking. But the interest this year, I think, was definitely a little higher. At the same time, I would have to say that the producers generally were taking a pretty cautious approach on M&A. Frankly, on a lot of things, they were taking a cautious approach, despite the increase in the price of gold. On M&A, no question that among the senior companies and the second-tier producers, by second-tier, I'm talking about big companies like Yamana or B2. I'm not yet talking about the juniors. Among the producers, there was a lot more talk about assets. In aggregate, there were a lot more assets for sale than there were people ready to buy. And the comment you got from a lot of people was just how few quality assets there were They had looked at this, they had looked at that. They thought this would be a good synergistic buy fit because it was next door or whatever. But when they dug deep, they found problems, and that, I think, was a theme that came up a lot: a lack of quality projects. And let me just, sorry, this answer will probably be the longest of all, because it's not really observations on Colorado, but it's sort of observations on the way the business is thinking. So that was certainly one thing. I think the other thing is that the mega mergers we had last year, Barrick and Randgold and Newmont and Goldcorp, both companies said they would be disposing of non-core assets. We've had very little of that come onto the market yet. But I think a lot of potential buyers of assets are probably waiting to see what comes out from Barrick and Newmont, because that's a sort of one-off opportunity, if you know what I mean. If you're looking at some exploration play that's developing a project in wherever, Peru, and you like it, and you're interested and you're watching it, well, it'll probably still be there 6 months or a year from now. But if Newmont wants to spin something off, it'll be a one-off. Okay, so I mean, a lot of these companies are really just waiting to see what assets come from Barrick and Newmont. But I mentioned a sort of generally conservative, if you want, or business-like might be a better word, approach. And it wasn't just M&A. It was with the prices that are being used, not so much for reserve reports, because, there's various rules that they have to follow on that. There's some flexibility, but there's still rules that have to be followed. But companies that were looking internally at projects as to whether or not they should be developed, some of them were still using 1250. And in fact, in one company I was at, one of the people said to me, "We'll probably increase that to 1300." And the VP of the CFO, rather, the CFO said, "No, you won't. 1275 at the highest." So I mean, that was sort of interesting when we've got a $1,500 gold price. So I think people have been hurt before, both with developing projects when gold moves up, developing marginal projects. They've also been hurt with, just like investors, with the gold price going up and then falling back. So, so overall, there's a more, you can call it what you like, conservative, business-like, rational, but certainly not irrational exuberance yet.
Two of the adjectives that other people I've had on the show recently have used were disciplined and positive to describe the sentiment at those two conferences.
Absolutely. Disciplined would be another word for what I'm saying, conservative, business-like. Yeah, disciplined, definitely, no question. People were not, and whether it was the exploration companies or the producers, yeah, they were not running around like crazy yet. Obviously people are positive on the gold price. I mean, it's nice to see the gold price up, and there was certainly some optimism, no question about that. But I think generally a more cautious optimism, or rational optimism, if you like. But having said that, I mean, I think a lot of people definitely felt that gold had turned. And I certainly agree with that. I mean, I'm very optimistic on the gold price. I think we just sometimes expect too much from gold. So when it goes from 1,300 to 1,500 in 4 months or whatever it is, we sort of expect it to reach 2,000 by the end of the year, and that obviously may not happen. So I think sometimes we expect too much, but I think definitely gold has turned for a lot of reasons, primarily the monetary factors. And, we'll see higher prices at the end of the year and next year, in my view.
Trilogy Metals is a world-class developer in Alaska's Ambler Mining District. The company already possesses 8 billion pounds of high-grade copper, 3 billion pounds of zinc, over 1 million gold-equivalent ounces, and over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion, with a 33% internal rate of return. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. The company is well capitalized, has no debt, and possesses strong institutional support. Trilogy trades in New York and Toronto under the ticker TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com. Adrian, I'd like you to respond to a recent quote. I believe this quote comes from the Financial Times. Jeffrey Christian, who is the chief executive of the CPM Group, which is a metals statistical and advisory service, was quoted as saying, quote, "Junior mining is dead, and I have been running CPM Group for 33 years. And for 32 of those years, we were talking to people about investing in mining companies or metal. Now institutional and retail investors are simply not investing in junior mining companies because they have lost money at it for so long." And what's your response to this quote here?
Well, I have the highest respect for Jeffrey, by the way. No, I don't really agree. I think time will change that. As human beings, we all tend to forget things we forget lessons fairly quickly. I think there's no question that at the moment, investors are not looking at the junior sector because they've not just lost money. They've lost, as Jeffrey knows, they've lost a lot of money. The juniors, it's easy to lose 80 or 90% of your money in junior gold mining stocks. And I know for a fact because I have some accounts transferred to me from people. And, they'll say to me, it used to be $1 million, but it's probably a couple of hundred now. And of course, when I get it, it's nowhere near a couple of hundred. It's 80,000 or something. So people have lost significant amounts of money. Those people won't come back anytime soon. But a lot of them are hanging in because they think they want to get their money back. But, so those people are not going to be adding money and so on and so forth. And then you also have the phenomenon of, dad lost half his money in the gold market and the kids, when they inherit, are not going to do the same thing. But I don't think this is permanent. And I get back to the thing that I said earlier. I'm not going to talk about peak gold or running out of gold or anything like that, but it is becoming increasingly difficult to find major deposits, big deposits. And, the statistics show that. They hold that up over, not just over the last couple of years, but over 15 or 20 years. The number of large deposits that are being discovered is going down. Is trending down, and in the last few years, significantly down. And it's not a matter of just a lower gold price so people aren't looking. You can correlate you can look at the amount of money that's being spent around the world on looking for gold. Last year, of all the non-ferrous metal spending, half of it was on gold, looking for gold deposits. And gold, of course, is nowhere near half the size of the whole non-ferrous metal market. But so people are spending money looking, and they simply are not finding. And yet the company that's producing 3 million ounces has to replace those ounces just to stay where it is. Very, very, very few companies in any sector will have a deliberate plan to shrink the business. Very few companies want to do that. Now, sometimes they grow unnecessarily for growth's sake, just to get bigger. But even if they're not planning on getting bigger just to get bigger, they don't want to shrink. And because it's a depleting asset, mining, you have to replace those ounces. It's very, very difficult. And most major mining companies no longer have exploration departments. It's astonishing. During the downturn from 2011 for the next several years, companies like Barrick, Newmont, lots of them, they just got rid of their exploration departments. And they rely, the juniors have become the sort of exploration arm of the seniors. So the juniors, admittedly, a lot of exploration companies will raise too much money, spend too much money, most of it on G&A and salaries. The salaries are extremely bloated for exploration companies, in my view, that don't produce anything as a rule, sorry. But anyway, the point I'm making is that the juniors will explore, and when they have a discovery, money will flow back in. There's no question about that in my mind.
Adrian, you like the royalty model, and we've actually done a webinar together where you talked about the royalty model. One of the royalty companies, Osisko Gold Royalties, has just made a bid to acquire Bakerville Gold Mines. They already owned 33% of the company, but now a royalty company wants to buy this development company. What are your thoughts here? I mean, is this kind of like deviating from the business plan to where investors could rightfully look at Osisko and say, hey, that's not what I signed up for?
Well, I think so. Now, Osisko, of course, has always been a hybrid royalty with their incubator or accelerator model where they put large amounts of money, as in Barkerville, they own 33% of the shares, as you said. So they've had this incubator model where they put money and large amounts of money into exploration companies to help them drill, and been sort of either on the board or certainly, lending technical assistance or whatever. So more than just passive investors. So it's always been a bit of a hybrid. I think I have two thoughts on the subject. One is, I think the deal for Barkerville may indeed turn out to be a very good one. They're getting it at a good price, about 0.6 of net present value for a development project. Isn't too bad. And Sean Roosen, the CEO of Osisko, and his team are very, very good. They're aggressive, but they're very good, mine developers and builders. Let's face it, they built the Canadian Malartic, largest gold mine in Canada in the last, 15 or 20 years. So they're very good at this. So that's number one. Number two, however, yes, it deviates from royalty model, and people buy royalty companies because of the low risk model. But when you buy a junior mining company and aim to develop a project, you remove that low risk aspect. So I think it may be a good deal for Osisko, but definitely Osisko, does not deserve to and will not trade at the sort of royalty multiples, because it just isn't a pure royalty anymore. But it's cheap now, in my view. The sell-off is overdone.
In the last 5 months, since gold has been rising, Adrian, is there anything different that you've done with your gold portfolio, or what you've recommended to clients, or were you pretty much positioned already in advance of this move and you just left your portfolio alone?
To a large extent, the second, but the change, yes, there's definitely been some changes, and that is, we've jumped on some of the senior stocks a bit. We've jumped on some of the senior stocks that we think will benefit, be the initial beneficiaries of the gold move. We all know this, but remember, when gold moves, when it begins to move, typically the senior companies move first. And then the junior producers, and then the exploration companies really don't move at all for quite a while until the market's well developed, and we've seen that already. The exploration companies that have moved in the last 6 months have been ones that have had a specific development, either a great drill hole or whatever. But there's been a specific positive development, and they will move on that, no question. Whereas 2 years ago, companies could put out good news and people took it as an opportunity to sell the stock. But now it's different. So good news is responded, but what I call the good company with good people doing good work, but without any particular news, they haven't benefited from this yet at all. The irony, of course, Bill, and I mean, we've talked about this before, I think, maybe not online, but the irony is that at the beginning of a bull market, sometimes the stocks that do best are the stocks of the worst companies. And by worst, I mean high cost of production and high debt. If you have high cost of production and high debt, you have much more leverage to a rising gold price than the company with the low cost of production and no debt. And so at the beginning of a bull market, those stocks will sometimes do better than the stocks of the good quality companies. That doesn't last because typically what I'll very generally call a bad company remains a bad company, even when the gold price goes up a couple $100. But certainly at the beginning of a bull market, leverage companies and the senior producers will move first. And we've tried to sort of move into some of those as opportunistic plays, yeah.
Adrian, this question I've asked a couple of recent guests, and it is, do you believe that we could have a really nice gold bull market but not see the industrial metals come along, so that it wouldn't be a full natural resource bull market, but it would just primarily be a gold bull market?
Oh, absolutely. No, absolutely. I mean, remember, everybody listening knows this, but gold and then to a lesser extent silver and platinum and palladium respond to certain factors that the base metals don't respond to. Now, there are certain factors that they all respond to, a lower dollar, etc., but higher inflation. But there are other factors that gold will respond to that the base metals won't. And we're sort of in that environment now where we have a slowing global economy. We have concerns about deflation. And of course, at the same time, we have the money supply exploding like crazy. So that's very positive for gold, but it's not so positive for copper, for example, or any of the other base metals.
Outside of gold, are there any metals that are maybe less followed, or even some sort of area of natural resource investing that you could share that you think might be poised for an upswing?
There's no question. I'm most positive on gold right now as a risk reward, no question, and silver secondarily. But to answer your question, I still am very favorably inclined to copper. I just think you might have to wait a couple of years, but if you look out, say, 3 years, there's very, very little doubt in my mind that there's going to be a supply deficit, which means higher prices. And that supply deficit is going to come not from increased demand necessarily, but it's going to come from a shortage of large-scale production mines coming on stream to replace the depletion of the mines that are already producing. So copper, I think, would be my main one. Some of the others I'm a little less optimistic on in the near term, to be honest, like uranium. 10 years from now, yes, it might be wonderful. 5 years from now, it might be, but I don't think there's any particular rush. So some of them were just slowly accumulating, but copper would be the one I'm most favorably inclined to.
Adrian, as we conclude, could you share your contact information if listeners would like to reach out to you?
Oh, that's very kind of you. It's Adrian Day. The company is Adrian Day Asset Management, and the website is adriandayassetmanagement.com, and the phone number or the email is assetmanagement@adrianday.com.
I always appreciate your insights, so thanks for joining me on Mining Stock Education today.
Well, thank you. Thanks for having me.
Silver One Resources is an exploration and development company backed by strategic investors Eric Sprott and SSR Mining. The company is focused on its Candelaria mine project in Nevada, where there is already a historic resource estimated at 127 million ounces of silver. The Candelaria mine historically was the highest grade silver producer in Nevada, generating over 68 million ounces of silver at an amazing average production rate of over 1,250 grams per ton. The project has tremendous expansion potential, as past drilling has outlined outline deeper, high-grade silver targets for future drill programs. Silver One is highly leveraged to the price of silver and is cashed up and poised to increase shareholder value. Silver One trades in New York under the ticker SLVRF and in Toronto under the ticker SVE. To learn more, go to silverone.com. That's silverone.com. Thank you for listening to this Mining Stock Education podcast. Please subscribe and share with like-minded investors. Visit us on the web at miningstockeducation.com for more resources on precious metals and natural resource investing. At our website, you can also sign up for our free newsletter for interview transcripts, stock picks, and more.